I'm Jim Cook with Plan the Cool Way, and I'm here to talk to you about some investment changes that I'm making inside of the models that I utilize for many of you. Why, Jim, do we need to change the investment model if the plan abides? If the plan is supposed to be there for long term perspectives? It is. But inside of each one of those sleeves that I utilize, I am always looking to say, should a sleeve lean a little bit in one direction or a little bit in another direction? I'm not talking necessarily about gross changes, although there is one that I'm putting into play that is a more large change. It's not massive. It's just a functional change, and that is this. Inside of the enhance sleeve, which is meant to focus on capital appreciation for money that you should not need for 3 to 5+ years, which means it has a long time to kind of ride out the humps. I am instituting a portion of this, a slice, to be exposed to what is called a flexible asset class investment or a tactical type investment. And that means that this particular area can say, hey, if it's really going to be raining a whole bunch outside, why be outside? Can't we just move the party inside? And even though it may not be as fun, we still preserve and protect. So the goal of this particular shift is to introduce that into a sleeve that I did not have formally before any tactical or flexible asset class exposure. So, Jim, if you're going to put something in that has protection capacity, are you really worried about the future? Worried? No. Aware of the fact that there are several economists who think right now that the stock market is fairly valued. Fairly valued means, depending on what happens with the Fed raising interest rates or profitability of companies, that this could go either way. Yes, I want to be aware of that. At times where it looks like we've got a nice straight road ahead of us, I like to say, can we just hit the gas pedal? Like, we know it's out there. Yeah, you might hit a bump in the road. Yeah, there might be a storm here and there. But when you know that you're heading into an area that's like, okay, this is a bit larger, and we need to perhaps take some caution, remember that I focus on preservation first and growth second inside of these different sleeves and for people's accounts. Now, while I have small little adjustments that happen across the board, the other reason that I'm bringing this up is that instead of a systematic semi-annual rebalancing that we would normally have, when the stock market drops about 20 to 25%, roughly where we are right now, save for this last little bump up, that's normally my time to say, hey, is it time to rebalance? Is it time to take that which preserved and use it to try to buy some things that may be discounted right now? In the same way that if the stock market had shot up very, very quickly for whatever reason, and normally it doesn't work as much like this, but it can happen like really, really high fast, that I'd say, can I preserve some of which we just made because things have really heated up? Whether we end up in a recession, whether we end up with the market continuing to slide further down, it doesn't really matter to me in terms of this enhanced sleeve. It is meant for longer term capital appreciation and growth. That's the focus of it. But in order to have a care for where things may go, whether they go up or down, and when we have sort of it could be a 50-50 coin flip chance on up or down over a period of time, I'm going to err on the side of prudence. Hopefully that helps explain what's going on this side of things. If for some reason you say, what are these models? And you haven't had that conversation with me, then we need to have it. Give me a call, send me an email, and let's do that. If you have any questions about how I'm positioned overall and positioning your money as well as my own, then please reach out.